Hi, everyone. Thanks for joining us today. This is the Retirement Income Strategies in Today's Market, hosted by Point View Wealth Management. We're going to give another 5 seconds here for some other people to join, and then we'll begin.
And thank you for signing in on time. We appreciate it.
All right, so it's 3 o'clock. Why don't we begin? My name is John Petrides. I'm a managing director and portfolio manager with Point View Wealth Management. Joining us today is Claire Toth, who is our vice president, chief operating officer, and financial planner. Unfortunately, David Dietze could not join us on today's call. But we have a very important topic today. This is our second webinar in a series, so expect more coming from us. But given the amount of baby boomers that are moving into retirement, we have many people joining the call. Either they're in retirement, they're looking for income strategies, they're approaching retirement, getting ready to move from the accumulation phase of life to the distribution phase of life, or they have parents that are in retirement and they want to offer a resource to them. So those are sort of the topics that we're going to be going through today, or at least the background. So before we begin this webinar, if you go to the right, you will find a chat button. Click on that, please, and ask questions. There will be a Q&A portion throughout the call. That is a private chat room, so only Claire and I can see those. So feel free to use that. There will also be a poll here that I'm putting up on your screen, and we love it. A lot of you have answered already, or published already. So the question is, what are your biggest fears in retirement? And there are 5 choices here to choose from. One is outliving your money. The second is a big sell-off in the stock market, i.e. 30%. The third is having to support your kids financially. The fourth is living in a nursing home. And the fifth is not being able to afford your lifestyle choice, travel, second home, etc. And if you can see the results, which we will keep open throughout this call, we're fairly evenly spread across. So we thank everyone for their participation. So let's go into the call here. There will be a replay of this call that we'll send out to everyone. Down here is our contact information with our email address and our website address. So if for some reason you don't get a replay of this call, or you want to forward this on to someone that you know that could be of interest, here's our contact information. This will be on throughout the entire slide, and they can reach up to us.
Okay. Sounds good.
So here's the team. A little background on Point View. You can see in the middle here, David Dietze is the Chief Investment Officer, founder, and president of Point View. Point View was founded in 1993 in Summit, New Jersey by David. Claire is to the right of him. She's our financial planner, as I mentioned. I'm in the corner, and rounding out the investment team below me is Elaine Phipps and Donna Sinamont. And then on the other side of David is the client service team, Jeanette Carey, Annette Tucker, Christina Gilmartin, and Marcella Garcia. So we round out Point View. So a little bit about Point View. We are independent. We are fee only. We're not fee based, and we are registered with the SEC. We've been recognized by CNBC and most recently in Financial Advisors magazine as one of the top independent fee only registered investment advisors in the country. Very proud of that. We do provide end-to-end wealth management where we customize investment portfolios and overlay financial planning on top of that. We manage for tax efficiency and for transparency. We do own individual bonds and stocks. We typically avoid ETFs and mutual funds, something that we're going to go through a little bit more here. We custody all of our assets at Fidelity, and our account minimum is $500,000 on an aggregated basis for all the accounts under management. We charge 1% for our management fee, but that includes a customized portfolio in addition to financial planning. Or if you're just interested in financial planning services, there's a flat fee of $7,000. Again, this is mentioned earlier. We have been acknowledged by CNBC and Financial Advisor magazine as one of the top wealth management firms in the country. So let's go into. I'm going to shut off my camera here, and as we're entering into the football season here, we're going to set up this presentation as where I'm going to do the play-by-play, and then I'm going to ask Claire to come in with the color commentary on each of the slides. So as we're talking about retirement income and planning for your retirement, you have to ask yourself two key questions. What are the income needs that you're going to have when you're in retirement? And what are your expenses going to be? So this way it helps you net out what your cash flow is going to be on a monthly basis, annual basis, 3 years. This is a critical question. So you have to plan out what are your retirement income sources. Is it coming from a pension? Do you have an IRA? Do you have a Roth IRA or a taxable account? Are you saving within a 401k or a 403b? If you're older than 70 and a half, are you taking your minimum required distribution? How are you taking that? Is it amortized over a monthly basis? Are you taking in a lump sum? What time of the year are you taking that? All these are crucial questions. And of course, how much are you getting from Social Security and how are you handling your Social Security payments? Are you deferring for as long as you can? Are you taking it currently? So, it's important to start out with where are your income sources coming from. Claire, did you have any thoughts on this slide?
Yeah. Well, John, as you had initially suggested, you also have to look at what you're spending. And I've seen typically retirement breaks on your retirement life cycle breaks into about thirds. Most folks, the first third of retirement, they're out there, they're doing everything, checking off stuff on the bucket list. Often expenses actually rise from the working years as people are traveling, they've got that second home, whatever. And although expenses rise, it's important to understand that a lot of these are discretionary. So if the situation changes, there is the possibility to cut back. Middle phase of retirement, people have pretty much settled into their groove. They're living their life. They've got it figured out. And then again, towards the end, expenses rise again with healthcare costs. Those tend not to be discretionary. So when you're building out where the income sources are, you've got to take into account the fluctuations in spending. Social Security tends to be the key for most folks. If you are not yet taking Social Security, it certainly behooves you to log into the Social Security website, set up an account, look at what you can expect to receive. At least in the northeastern part of the United States, the rule of thumb is that Social Security will support you for about 1 week a month. That can be a significant portion of your required monthly expenses. Beyond that, if you're lucky enough to have a pension, that's another big chunk. For most folks, most of their retirement income is on them, either in retirement savings or in a taxable account. And as John alluded to, the retirement savings come in two flavors: the traditional, where everything, whether it's an IRA, 401k, 403b, everything that comes out to you is ordinary income. More recently with Roth IRAs and now Roth 401ks, there is no requirement to take funds out, but if you do, they're tax-free. So
right,
that's a lot of balls in the air, but we can take all that and move on.
Yeah, this is a great setup for the rest of the slide deck. So we have about 10 or 11 topics here. The first one, when you're in retirement and building your portfolio and your assets, really is diversification. And clearly this is rule 101 at any point in time in your life in terms of when you're building your wealth. But when you're in retirement, you're moved to the distribution phase of life. You're no longer bringing in an income for the most part. So having your assets spread out is really important. So if one asset class tanks, you haven't disrupted your overall retirement plans or your objectives. So we work very hard in terms of creating the right asset allocation between stocks and bonds, but then it's also breaking down and diversifying the stock allocation and the bond allocation. So in terms of spreading out maturities and credit quality. So diversification is key here.
And John, remember, it's not just diversification of the assets, which is the piece of it he focuses on. It's also, as I alluded to, diversification of the kind of accounts you have, because every account has a different tax flavor. So just as you're mixing and matching your investments, you can mix and match the tax consequences of how you generate that income.
Yeah, that's great. We're going to get into that a little bit more in a later slide. Right now, bonds are a bond is literally a 4-letter word. with the pace that with where interest rates are and the fear that interest rates are going to balloon higher, many investors are very fearful of owning bonds. When ironically, 10 years ago, we're lapping the Lehman Brothers collapse and the heart attack that the financial markets sustained in September of 2008, where everyone was flooding into bonds. You have the opposite reaction right now, or the opposite thought. But this is a really interesting chart. Some of you have seen this before, going back to 1929. The green bar shows you all the years, or the blue bar shows you all the years the stock market has sold off up until 2016. Okay, so going from 1929 to 2016, the blue bar is what happens when the stock market sells off. The green bar shows you how bonds performed in the same year that the equity market sold off. And you can see, with the exception of the early 70s and in 1931, bonds rose when stocks sold off. So this is key when you're in retirement and you're fearful of what's the preservation of your capital, that bonds need to be a portion of your overall asset allocation to provide the suspenders when the equity market gets volatile. We like to own individual stocks and bonds. We typically avoid mutual funds and ETFs. Fees are fairly expensive. They're very tax efficient, particularly for the mutual funds, because they don't know who you are. They're not customizing the fund for you. They're trying to achieve the best performance. So they could have bought Microsoft in 1995 and they're selling it today, and they're saddling you, the mutual fund owner, with a tremendous amount of capital gains. There's no transparency on a mutual fund or ETF. You don't know what's going on underneath the hood until the end of the month when they produce their top 10 holdings. We believe in customizing the portfolio so all the securities and the cost basis is in your name, and you have tremendous control on the underlying portfolio. ETFs, although particularly low-cost ETFs, are still untested. We saw what could happen to leverage ETFs back in 2008. We saw what happened to the volatility ETFs earlier this year when they exploded with volatility reverse. So there are some dangerous ETF products out there. But even indexed ETFs are still an untested product in a very volatile time in the stock market. Here is a problem with mutual funds. So we have software for Morningstar where we can provide an X-ray on clients' current mutual funds. And a client could come in and say, I feel very diversified. I own 7, 8, 9, 10 different mutual funds. So in a stock market sell-off, I feel like I'm diversified because I've checked a lot of boxes. But when we analyze the mutual funds that they own, we lift up the hood and look, they're not really as diversified as they seem. I mean, look here. Here's one person, 1, 2, 3, 4, 5, 6. They own 7 different mutual funds, and all 7 of them own Microsoft. What about Amazon, Alphabet, Apple? It's not a surprise that these are 4 of the largest market caps in the S&P 500 right now, and they're also held in every index because most of these most of these mutual funds are market cap weighted. So, and what if one manager is selling Microsoft while the other one's buying? So mutual funds have a tendency to mask, think that clients are more diversified than they actually are. And annuities are not the answer. We're fee only, not fee based. We don't sell annuities, nor do we really believe in them because of their hidden cost structure, because the enormous amount of fees. Annuities were, again, the soup du jour post 2008, 2009, when there's a tremendous amount of volatility. And we don't find these to be particularly attractive. Claire, maybe you can go into a little bit more of the caution or risks with owning annuities.
Well, and I also want to say annuity is one of these words like value or health or quality that you think you know what it is, but you need a whole lot of modifiers. There are a lot of different kinds of annuities, but the ones that most folks think of today are variable annuities, which are sort of a not particularly attractive IRA with an insurance wrapper around them. They tend to be sold as a retirement product. However, most folks who buy annuities would do a whole lot better to be contributing the maximum amount to their employer retirement plan, and to their IRAs. Those are much less expensive products with a lot more control. Annuities have even worse tax consequences than IRAs and 401ks. And there's just so many different kinds. It's hard to say, it's hard to make really specific, really general statements that go across the board. We're always happy to take a look at them on folks' behalf. The last one I took a look at, the investors would have been better off buying a portfolio that was 80% treasury bonds and 20% S&P 500 index fund, which would have been a whole lot cheaper than the annuity they bought.
Great. Here's an interesting one. Don't be excessively conservative. Life expectancy for men and women keep increasing. And, there's this, the old textbook adage was, well, you take 100, you subtract your age, and that should be your equity allocation. Well, you can throw that out the window because, someone who's 65 today, living in retirement, has a decent chance of living another 25 or 30 years. So the last thing they can do is afford to put on the brakes entirely and be overly in bonds or be 100% in cash. You need a portion or a substantial portion of your portfolio to have a capital appreciation focus. You need to still be growth focused despite being in retirement. And again, it's a scary time of life because the paycheck is no longer coming in and you have to live off the fruits of your labor in your retirement accounts. So, the knee-jerk reaction is to be more conservative, but you still need to be pro-growth and have a higher level of allocation equities to provide that growth.
And diversification really does give you a lot of the downside protection because the old saw, not everything moves in lockstep. As that one slide John showed you, even when stocks tank, bonds will hold their own. And then, of course, 2 out of 3 years, if not more, the stocks are going up. In addition to longevity risk, which is living longer than your money, we've forgotten about inflation risk. It's been a long time since there's been any kind of serious inflation. But most of us do remember the late 70s and the early 80s and double-digit inflation, the days when people were happy to have a 12% mortgage because it was low rate. At some point, and I don't know when, we're going to see significant inflation again. If you're too conservatively invested, you're not going to be able to keep up. Even at a 3% inflation rate, prices double in 24 years.
Here's another issue that we come across is, stay away from private investments. I think we find a lot of retirees who get lured into, flashy presentations and prospects of high returns for private investments. But what they're giving up is liquidity, and they're usually paying for those returns. A lot of private investments can seem and sound attractive, but if you need liquidity in retirement, many of those investments have lockup periods, or there are only certain windows during the course of the year when you can sell out of it. And that could be a time when, if you're at the inappropriate phase of retirement that Claire mentioned, where you need cash flow, you may not be able to access it because the investment has it locked up.
And I've certainly seen folks who are over age 70 and a half who are required by law to take distributions out of their retirement accounts, and who, because they're in private investments, don't have the cash flow to take that money out. The tax penalty for not taking your required minimum distribution is 50%. So that's a pretty high price to pay.
This is a great chart, slide, and I think it's probably one of the more important ones of today's deck. And I want to turn the mic over to Claire because you alluded to it earlier. And it's about not only getting the right asset allocation, getting the asset allocation correct between stocks and bonds, but it's what account do you put it in?
Right. And we like having the equities, the stocks, in your taxable accounts and then in a Roth account if you've got that as well. Those are tax favored accounts. The dividends, the capital gains come out at 15% rate for most folks. Whereas taxable bond income is coming out at whatever your highest marginal rate is. That can be as high as 37%. The other reason, these assets are also tend to be the faster growing ones. If there's a down year or a down stock, you have the ability to sell and take a capital loss, which is also very helpful for tax purposes. On the other side, putting bonds, and specifically taxable bonds, in retirement accounts means a couple of things. One is you're not paying current income tax on the bond income. Second, and I've seen this a lot with folks who are really diligent savers throughout their earning years, they may have retirement accounts that are so big, by the time they turn 70 and have to start taking distributions, they find themselves swimming in ordinary income that they can't even spend. If you see that coming down the road, and we often can, then it really behooves you to have the slower growing assets in the retirement accounts so that you don't find yourself with all kinds of ordinary income you don't need. I know that sounds like a good problem to have, but I've seen it happen.
And then I guess the key too on stocks, if you're going to talk about the step up in cost basis.
Right. When somebody passes away, assets in a taxable account get a brand new cost basis equal to the fair market value at the date of death. So if someone dies owning 100 shares of Exxon that they bought at 5 cents a share, their heirs can sell it the next day tax-free. With retirement accounts, there is no basis step up. Your beneficiaries have to take money out of the accounts, and everything that comes out to them is coming out as ordinary income. So again, dampening the size of the retirement accounts relative to the taxable accounts is good for you, and it's good for your heirs.
Great. This next slide really dovetails into the private investments. Again, alternative investments. Again, same idea here. High fees, locks up your liquidity, and the returns, may sound great, but that could have happened in the past. There's no guarantee you're going to get that in the future. So I guess this dovetails into the slide earlier, private investments. Another point is timing. Trying to time the investments in your retirement is a very tricky thing to do. And here we leave it off with politics and investing don't mix. Okay. So, if you were entering retirement in 2016, on the eve of the election, you may have been frightened by what the outcome may or may not have been. But you would not have expected probably this stock market movement. I think we've had a 34% gain in the S&P 500 since the President Trump's election. And that was clearly not market sentiment on the eve of the election. We fielded a lot of phone calls from various people who were very nervous about where the future was headed. And there's a lot of nervousness to be out there, but that's the whole idea with the stock market. Don't let perception or current market sentiment dissuade you or derail you from what your long-term financial goals are. And so it's very important not to try and time the market. In today's world, it's fear of the unknown because of the political situation.
And certainly today, what we're hearing from clients isn't so much the market's going to tank because of the election as the Fed is going to raise rates, inflation is back, I hate bonds. And for all the same reasons you shouldn't have hated stocks in November of 2016, you shouldn't hate bonds today.
Mm-hmm. And here's another topic that we discuss often is it's not necessarily income, it's about total return. And what is total return? That is the dividend income or the interest income from the bond plus the capital appreciation of the underlying investment. So your total return is the stock price movement plus your dividend. And really for up until 2018, for the past 9 years, investors have been tripping over themselves to try and find income. Remember when MLPs, master limited partnerships, were where people couldn't get enough of them. REITs, utilities, telecom. Those stocks where investors wanted low volatile stocks that had a above average dividend, 3.5% or higher, where companies that grew that dividend. I mean, that was the play. That was the income play that investors were looking for entirely. Well, right now in 2018, investors have turned their back on that in that entire play. Those bond-like surrogates, those bond proxies, consumer discretion, consumer defensive stocks, telecom, utilities, REITs, MLPs, those stocks have performed terribly because of fears of rising interest rates. So ironically, income has gotten higher, yields have gotten higher, but investors have vacated. They've run away from that environment. So our thought has always been, focus on the total return, not just the income. And of course, it always goes back to valuation. It's not about chasing the hottest stock or chasing just the highest yielding bond. It's what are you paying for those investments. We don't chase the crowd. We think that's a very bad place to be. Human nature is to go with the winner, what's actually working. But when you look long term, it's usually going the opposite direction over the long term that builds more wealth. For example, 10 years ago, would anyone have said, the environment was, oh my God, the world is coming to an end. But if you invested in the stock market 10 years ago today, and you went counter when everyone was running when everyone was running away from stocks and embracing bonds, your returns would have been fantastic. You would have had heroic returns over a 10-year period. And we're going to see that, that story, be told more and more often over the coming 12 to 18 months, how stocks have been an incredible place to be over the past 10 years, despite the fear. I mean, how many times have we discussed, how this has been an unloved bull market? But we're entering now, we've just entered the longest bull market in the history of stocks. So it's very important that it's not just buying stocks or bonds, but what are you paying for those underlying investments? And here's another important one is when you're in retirement, don't fail to consider muni bonds. Again, this time last year, there was a lot of fear with the change in the tax code that the government may do away with tax exemption on state and local muni bonds. And that didn't happen, thankfully. And we do believe that owning muni bonds, if you happen to have fixed income as a portion of your taxable account, is a very effective way to earn income. Because at the end of the day, what we're trying to do is, it's not just your performance, your returns, but it's your returns after inflation and after paying taxes.
And certainly, although the tax law changes did not eliminate municipal bonds, they did eliminate an awful lot of tax deductions we've known and loved. And that puts more and more stress on, rather than trying to find more deductions, trying to find ways to reduce your taxable income. Municipal bonds are an obvious way to go. And again, with diversification, don't focus everything on New Jersey. New Jersey remains in real fiscal straits, and it isn't just New Jersey. If a state like Illinois really starts having problems, believe me, New Jersey is going to catch the flu. States, there are states out there that are really interesting to look at, states that tend not to have their own income taxes and therefore aren't really attractive to their own retirees. Think Washington State, Texas, Florida, some of the others. Those states tend to issue municipal bonds with slightly higher interest rates because they've got to attract out-of-state investors. And those are states that we tend to look at.
Right. At this point in time, we're going to go to our Q&A section. So again, if you can go to that chat button and click in any, we'll answer some of your questions. Before we do that, I'm going to end the poll here. Again, what are your biggest fears in retirement? A third of you said outliving your money. 20% were fearful of a stock market correction of 30% or so, a big stock market correction. 7% were fearful of having to support your kids. 13% living in a nursing home, and 27%, or about a third, not being able to afford the lifestyle choice. So fairly evenly dispersed.
Well, yes, but that means about 50% of our participants are concerned about one way or the other not having enough money. And it's a valid fear. I heard fairly recently that a poll of executive women, all earning mid six figures or higher, well over 50% of them were afraid of becoming bag ladies. And my response was, is that all? I think all of us have that underlying fear somewhere. And a lot of what we do is quantifying things. Knowledge is power. If you understand how your money is working for you, you can allay some of those fears.
All right, so some questions are coming in. One is, Claire, what are your thoughts on target date retirement mutual funds? So, obviously, good question. Clearly, these have become popular products over the last 5 to 10 years. Obviously, you heard our comments on mutual funds. Target date funds typically have higher expenses because they require more labor on the mutual funds part as they rebalance over the course of the life cycle.
Let's talk about what a target date fund is. They tend to show up particularly in retirement plans, and they're often defaults. If you participate in a 401k, or even if you're not contributing but your employer's matching, and you don't say what investment you want your contributions in, it'll go into a target date fund. It's better than cash. That's the good news. With the target date fund assumes that you will retire when you're 65 and that it's the only asset you own. So early in a working career, 20s, 30s into your 40s, they're fairly heavily invested in stocks versus bonds. There's always some bonds. And as you get closer to that target date, the allocation switches so that at age 65, you're 100% bonds. And first off, as we've already said, if you're 65, you're 2/3, you've still got a third of your life left to go, or you need at least to be invested as though you do. So bonds aren't going to do it. They also act as though they're the only investment you've got. And hopefully you've got assets outside of your employer retirement plan. And so what's in the employer retirement plan should be coordinated with everything else. The target date fund is a one size fits all. And again, it's better than nothing, but it's probably not best for anyone.
I'll take this next question. It says, where are you finding income ideas in today's market? Well, I think it goes back to the slides of valuation and focusing on total return. But it has been those traditional higher dividend paying stocks that have a negative correlation, that are sensitive to rising interest rates, that have sold off very aggressively, that we're finding value today. So telecom looks attractive. Consumer defensive stocks, the safer parts of the market, the more conservative parts of the market, companies that generate a lot of cash flow, that have a good history of returning it to shareholders, right now look the most attractive. So again, utilities, telecom, REITs, consumer defensive stocks, those stocks have sold off pretty sharply this year, and their yields are quite attractive. So from a total return standpoint, although we take a diversified approach, those are places that we're finding income ideas today.
Okay. And another question is, I'm retirement age. Am I still able to contribute to retirement plans? And the answer is, it depends. In order to contribute to a 401k, to an IRA, to a Roth IRA, the first thing you need is earned income. So you do have to be working, or your spouse has to be working in order for you to be able to make a contribution. If you are 70 and a half or older, you're no longer able to contribute to a traditional IRA. You can contribute to a Roth IRA if your income is within the eligibility limits. The interesting one is with a 401k. If you are still working, you're age 70 or over, you are able to contribute to a 401k so long as you don't own 5% or more of the business. If you're a business owner, then you can no longer contribute. You do have to take required minimum distributions, but the money can go both in and out in the same year. So you can continue reducing your taxes at the top end.
Another one here, someone is emailing and they recently retired. What happens with the 401k at their old employer? And I guess you could add to that, Claire. I'm sorry to interrupt you, but if someone had a pension, what is what should they do in that situation?
The pensions and the 401ks are treated separately. Pensions often, but not always, give you the option to do a lump sum rollout to an IRA. And there you have to do the math, because the pension plan is going to have some assumptions in there about what it's returning, what its investment returns are when you're calculating what the monthly payout is. And if you think you can do better on outside of the pension plan in terms of investment return, it makes sense to roll it out. Some people want the security of that monthly check. They want to know that if there's a surviving spouse, that he or she will be taken care of. And there are plenty of times where taking the pension makes sense. I mean, you've got to sit down and work your way through it. With the 401k, you really want to roll it out into an IRA. Your employer doesn't want to chase you down post-retirement. You have a lot more flexibility in an IRA. If you leave the money in a 401k and you have minimum required distributions, you've got to take your 401k minimum required distribution from that 401k and then take a second required distribution from an IRA. It's a lot more paperwork and administrative hassle.
What about, Claire, Roth 401ks? Fairly new product. We may have some friends on the line here who are either employers or employees still working, or maybe they're retired, but their kids are working. A Roth 401k is a fairly new product and probably should be taking advantage for anyone who has access to it, correct?
I think it makes a heck of a lot of sense. Many people make enough money that they're not able to contribute directly to a Roth IRA. Those are income limited. You may or may not want to do IRA conversions into them. But with the Roth 401k, I tell folks, in their earning years, they tend to be high tax years. So put a minimal amount into the Roth 401k. It's important to get it going because all of the good things that happen with the Roth, the tax-free build-up forever, no required distributions for permitted purposes, all of that stuff, the Roth has to have been around for 5 years. So get that stake planted in the ground. If your employer will let you throw in $50 or $100 a pay period, go ahead and do it, get it going. And then later on, if you've got a low income year, either because you're between jobs, you retired early, something like that, you can take advantage of the fact that the Roth exists and make bigger conversions. Mm-hmm. And I know I packed a lot into that. I'm happy to unpack it one-on-one for anybody who wants to follow up.
Yeah, I think the Roth products in general are very important because, again, if you know what a Roth is, a Roth IRA is you contribute to the Roth. All the capital gains are tax sheltered, and then when you take the money out of the Roth, it's all tax free. So right. It's a very effective retirement savings vehicle, but there are some nuances around it, and clearly we can help anybody who has further questions on that. Right. One other question coming up here is, do you use stop loss measures in your securities? And the answer is no, for a couple of reasons. One, it's expensive to do a stop loss measure. Clearly, there are added ticket charges that are applied. And B, we believe that we're investors in a business, and if the stock goes down, the business goes down, unless there's something fundamentally wrong with the underlying business, in theory, we should want to buy more. We should find it more attractive. It's kind of like you go into a store and you want to buy your favorite sweater and they put it on sale, Well, you don't walk away. You want to buy it because it's on sale. It's at a cheaper price. That's kind of how we look at a stock, is that if we really like a company and we really think it's got an attractive business model, we don't disregard it simply because the stock price has gone down. We analyze the position to see if, hey, is this an attractive buying opportunity? And if the stock has gone down simply because the underlying fundamentals have changed, well, then that's a different story. But we don't want to, enact the trigger simply because it's down. Again, I go back to 2008 when, the S&P 500 was down 37%. That would have triggered any stop loss, and you would have gone into cash. Well, then the question is, when do you go back into the market? Well, how do you know? Nobody has a crystal ball what the future holds. So we are not believers in using stop losses for investments. That's the idea of where diversification comes into play, where bonds come into play. And to be honest with you, we typically do not own a security more than 3%. We equally weight the sectors in the portfolio. So we work very hard to avoid concentration risk within a client's portfolio to prevent where, if there is a big sell-off in one position, it doesn't derail a client's financial objectives or goals. I'm not seeing any more questions. So Claire, thanks for your time. Thank you everybody for joining this call. We hope you got a lot out of it. There will be a replay on this. We will be posting it to our website. You will all be getting a replay on this call. So, if you have any questions, again, at the bottom here is our contact information. Please feel free to reach out to us. And, thank you again for your participation, and be on the lookout for more webinars in the future. Take care.
Thank you all for participating.